I was having coffee with my friend Karen a few months ago. Karen is 54, has rented her whole adult life, and every few years somebody in her family gives her grief about it. You're just throwing money away. You'll have nothing to show for it. You know the speech. Except Karen just hit a net worth of $1.4 million. She's never owned a home, not once. And I'm sitting there thinking, wait, how does that happen? That goes against everything we've been told since we were old enough to think about money. Buying a home is the foundation of wealth. Renting is a trap. That's the rule. So I started digging, and what I found genuinely surprised me, because it turns out Karen isn't some freak outlier. There are people all over the country who chose renting over buying and ended up in better financial shape than their homeowning neighbors. Not because they got lucky, because of some very specific money decisions that most people never think about. So stick around, because I'm going to walk you through exactly why this happens, and some of these reasons are going to make you rethink everything you thought you knew about renting versus buying. Reason 1. The hidden costs of homeownership are enormous. When people talk about buying a home, they focus on the mortgage payment, but the mortgage is just the beginning. Property taxes, homeowners insurance, HOA fees if you're in certain communities, and then there's maintenance. The general rule of thumb in real estate is that you should budget 1 to 2% of your home's value every single year just for upkeep. On a $400,000 house, that's $4,000 to $8,000 a year, money that just disappears. New roof, HVAC system, foundation issues, appliances that break at the worst possible time. I talked to a couple in Ohio who bought their home in 2015 for $280,000. By the time they tallied up 10 years of property taxes, insurance, maintenance, and a major kitchen remodel they didn't plan for, they'd spent over $90,000 on top of their mortgage payments. Renters don't pay any of that. The roof leaks? That's the landlord's problem. The water heater dies on a Sunday night? One phone call. Renters get to keep that money. Reason 2. The down payment invested elsewhere can grow dramatically. Here's the math that nobody talks about at closing. The average down payment on a home right now is somewhere around $60,000 to $80,000, depending on the market. That's a massive chunk of money going directly into a single, illiquid asset. You can't spend it, you can't access it easily. It just sits there, tied up in your walls. But what if instead of putting $70,000 into a down payment, you kept renting and invested that $70,000 into a diversified index fund portfolio? Over the last 30 years, the S&P 500 has averaged roughly 10% annually. At that rate, $70,000 invested in 1995 would be worth well over $1.2 million today. Meanwhile, the average home bought in 1995 for around $150,000 is worth maybe $400,000 to $450,000 now, and that's before you subtract all the money spent on taxes, insurance, and maintenance over 30 years. The numbers aren't always in favor of buying, especially in expensive markets. Reason 3. Renters can move toward opportunity without penalty. This one is huge, and I don't think people appreciate it enough. When a better job offer comes up in another city, homeowners face an enormous decision: sell the house, deal with realtor commissions, closing costs, the timing of markets. That's typically 6 to 10% of your home's value gone right off the top when you sell. Or do you keep the house and become a landlord from afar? That comes with its own headaches. Renters just give notice. I know someone, a software engineer in her 30s, who has moved 4 times in the last 10 years, chasing higher salaries. She went from $65,000 a year to $180,000. She estimates her career mobility alone has added hundreds of thousands of dollars to her lifetime earnings because she was never anchored to a zip code. When you own a home, your financial life is tied to one local economy. When you rent, you can follow the money wherever it goes. Reason 4. Renters avoid buying at the wrong time. The housing market is cyclical, and buying at the peak can set your finances back by years. People who bought homes in 2006 watched their home values crater by 2009. Some lost 30, 40, even 50% of their home's value. And unlike the stock market, where you can just hold and wait, a home still demands property taxes, maintenance, and mortgage payments, even when it's worth less than what you paid for it. Renters in 2006 kept their cash flexible. They weren't underwater, they weren't trapped. And when prices eventually bottomed out in 2011 and 2012, some of them had the cash and the credit to buy at generational lows, or they just kept investing while homeowners were busy recovering. Flexibility during a downturn is worth more than most people realize.
Reason 5. Investing the monthly savings compounds over decades. Here's where it really gets interesting. In expensive cities, renting is often significantly cheaper than owning a comparable property when you factor in everything. In San Francisco, New York, Austin, or Miami, the monthly cost of owning, mortgage, taxes, insurance, maintenance, can run $1,500 to $3,000 more per month than renting a similar place. If a renter takes that difference, let's say $1,500 a month, and invests it consistently over 30 years at a 7% average return, that's over $1.8 million. That's not a hypothetical, that's the math. The person who rents and invests the difference can absolutely end up wealthier than the person who buys. It just requires the discipline to actually invest that money instead of letting it evaporate into lifestyle creep. That's the key word, discipline. The strategy only works if the savings actually get invested. Reason 6. No exposure to a single concentrated asset. Financial advisors spend a lot of time talking about diversification. Don't put all your eggs in one basket. Spread your risk across different assets, different sectors, different geographies. And then a lot of those same people turn around and tell you to put the majority of your net worth into a single house, in a single neighborhood, in a single city. For most homeowners, their home represents 60%, 70%, sometimes 80% of their total wealth. That's an enormous concentration of risk in one asset that they can't easily rebalance, can't liquidate quickly, and can't hedge against. Renters who invest don't have that problem. Their wealth is spread across hundreds of companies, multiple asset classes, maybe some bonds or REITs. If one sector tanks, they're not wiped out. Diversification is one of the most powerful risk management tools in finance, and home ownership fundamentally works against it. Reason 7. Tax advantages that renters actually have access to. Everyone talks about the mortgage interest deduction for homeowners, but here's what they don't mention. Since the 2017 tax law changes, the standard deduction nearly doubled. The majority of homeowners, especially those in the early years of a mortgage, when payments are mostly interest, no longer benefit significantly from itemizing. Meanwhile, renters can max out their 401k, fund a Roth IRA, use health savings accounts, and invest in taxable brokerage accounts with favorable long-term capital gains treatment. Done strategically, a renter with a good investment plan can manage their tax burden in ways that homeowners with most of their wealth locked in real estate simply can't. It's not that renters get better tax treatment across the board, it's that the tax advantages of homeownership are often overstated, while the tax efficiency available to disciplined investor renters gets ignored. Reason 8. Freedom from financial stress changes everything. This last one is harder to put a number on, but it's real. Home ownership comes with a specific kind of financial pressure, a big fixed monthly obligation that doesn't go away whether you lose your job, get sick, go through a divorce, or face any other life disruption. Miss enough mortgage payments and you lose everything: the house, the equity, the credit score, all of it. Renters carry a lighter financial burden. If things get hard, they can downsize quickly, move to a lower cost of living area, negotiate rent. Their housing situation has more flexibility built into it.
And there's significant research showing that financial flexibility reduces chronic stress, which has downstream effects on health, decision-making, and career performance. The people who are least financially anxious often make better long-term financial decisions because they're not operating from a place of fear. Now, before I wrap up, the reality check. Renting isn't automatically better than buying. I want to be clear about that. In the right market, at the right price, with the long enough time horizon, buying a home can absolutely build significant wealth. And for some people, the stability, the permanence, the ability to renovate and make a space truly yours, those things have real value that doesn't show up in a spreadsheet. Everything I've talked about today assumes a few things: that the renter is actually investing the money they're saving, that they're in a market where renting is genuinely cheaper than owning, that they have the discipline to stay the course for decades. If you're renting and spending every dollar you save on dining out and vacations, you're not building wealth, you're just renting. But if you're renting intentionally, keeping your costs low, investing consistently, staying mobile, and diversifying your assets, you might be playing a smarter long game than your friends who are posting photos of their new kitchens. Karen knew something a lot of people are still figuring out. The path to wealth isn't one size fits all, and sometimes the conventional wisdom is just conventional, not wisdom. Have you ever considered renting long-term as a wealth strategy? Or do you think homeownership is still the gold standard? Drop a comment. I'd genuinely love to know where you land on this. And if you want more videos that challenge the financial assumptions most people never question, hit subscribe. The next one might change how you think about money all over again.